On a quiet summer day in 1883 in downtown Cincinnati, a 24-year-old entrepreneur named Bernard Kroger made a decision that would shape the future of American retail. He invested his life savings, just $372, to open a small grocery store. His philosophy was simple but radical for the time. Be particular. Never sell anything you would not want yourself. That store became Kroger. Fast forward more than 140 years, and Kroger is now one of the largest retailers in the United States, generating over $100 billion in annual revenue and operating thousands of stores across the country. It is not just a grocery chain, it is a retail empire, one that quietly reshaped how Americans shop for food. But Kroger's rise wasn't built on hype. It wasn't a Silicon Valley tech unicorn. It didn't explode overnight on Wall Street. It was built on something far less glamorous: operational discipline, vertical integration, and relentless expansion. And that is where this story begins. The early innovation that changed grocery retail. In the late 1800s, grocery stores were simple operations. They stocked dry goods, but Bernard Kroger believed in control over quality, supply, and price. In 1901, Kroger became the first grocery chain in America to operate its own bakery. That move shocked competitors. Why would a grocer bake its own bread? Because it eliminated the middleman. Soon after, Kroger added meat departments, then dairy plants, then food manufacturing facilities. Decades before the term vertical integration became popular in business schools, Kroger was already practicing it. This strategy gave Kroger a powerful advantage: lower costs and consistent quality. By the 1920s and 1930s, Kroger had grown into one of America's largest grocery chains, operating hundreds of stores across multiple states. And then came the supermarket revolution, the supermarket era. In the 1930s and 1940s, the American grocery experience began to change. Self-service shopping replaced counter clerks. Larger stores replaced small neighborhood shops. Kroger didn't resist the change. It embraced it. The company invested heavily in larger format stores, parking lots, and centralized distribution systems. It modernized, it scaled, it optimized. By the 1970s and 1980s, Kroger had become a dominant force in regional grocery markets across the Midwest and South. But something else was happening. A new type of competitor was rising: discount giants, warehouse clubs, and eventually, the biggest threat of all, Walmart. The competitive pressure cooker. When Walmart aggressively expanded into groceries in the 1990s, the industry changed forever. Walmart supercenters combined groceries with general merchandise at prices traditional grocers struggled to match. Margins shrank, competition intensified, and many regional grocery chains disappeared. Kroger survived, not because it was the cheapest, but because it was disciplined. Throughout the 1990s and early 2000s, Kroger went on a massive acquisition spree. It acquired chains like Fred Meyer, Ralph's, King Soopers, and Harris Teeter. Each deal strengthened its regional footprint and gave it scale. Scale meant purchasing power. Purchasing power meant better pricing. Better pricing meant survival. By the early 2000s, Kroger had cemented itself as the largest traditional supermarket operator in the United States. But the real transformation was still ahead, because grocery retail was about to face its biggest disruption in history: e-commerce, Amazon, and a global pandemic. For over a century, grocery retail had been predictable: thin margins, high volume, local competition. Then, in 2017, everything changed. That was the year Amazon acquired Whole Foods Market for $13.7 billion. Wall Street panicked. If Amazon could sell books, electronics, and cloud computing, why not groceries? And if Amazon entered grocery with its logistics dominance and data expertise, what would happen to traditional players like Kroger? The market reacted immediately. Kroger's stock fell sharply after the announcement. Analysts warned of a price war. Commentators predicted the Amazonification of food retail. But here's what many people misunderstood: Kroger wasn't asleep. The quiet digital transformation. Long before Amazon bought Whole Foods,
Kroger had already begun investing heavily in digital infrastructure. It launched ClickList, later rebranded as Kroger Pickup, allowing customers to order groceries online and pick them up curbside. It built automated fulfillment systems. It invested in data analytics. It even partnered with British tech company Ocado to build high-tech robotic warehouses in the US. Kroger wasn't trying to beat Amazon at being Amazon. It was trying to leverage its biggest advantage: physical stores close to customers. More than 90% of Americans live within a short drive of a Kroger-affiliated store. That proximity gave Kroger something powerful: last-mile efficiency. When COVID-19 hit in 2020, that strategy paid off. The pandemic surge. As lockdowns spread across the country, grocery demand exploded. Online grocery orders surged. Pickup and delivery became essential. Consumers who had never ordered food online were suddenly doing it weekly. Kroger's digital sales more than doubled during the early stages of the pandemic. Revenue climbed, profits strengthened, investors regained confidence. For a moment, it looked like Kroger had successfully navigated the biggest disruption in retail history. But pandemics don't last forever, and once the world reopened, growth slowed. At the same time, inflation began squeezing consumers. Food prices rose, labor costs increased, supply chains became unstable. Margins tightened again. And then Kroger made a move that shocked the entire industry: the Albertsons acquisition. In October 2022, Kroger announced plans to acquire Albertsons in a deal valued at approximately $24.6 billion, including debt. If approved, the merger would combine two of the largest grocery chains in America. The goal? Scale. More buying power, more leverage with suppliers, more efficiency, and the ability to compete more aggressively against Walmart, Costco, and Amazon. But the announcement triggered immediate backlash. Regulators raised concerns about reduced competition. Labor unions protested potential store closures. Politicians warned about higher prices. The Federal Trade Commission launched a review. Several state attorneys general filed lawsuits to block the deal. Critics argued that fewer grocery chains could mean higher prices for consumers and fewer choices in local markets. Supporters argued the opposite, that without the merger, traditional grocers would struggle to compete against Walmart and Amazon's dominance. It became one of the most controversial retail merger attempts in decades, and while regulators debated, uncertainty hung over the company. Investors questioned whether Kroger was overreaching. Employees worried about restructuring. Competitors watched closely. Because if the merger failed, Kroger would still face the same structural challenges: thin margins, aggressive competitors, and rapidly shifting consumer behavior. The grocery industry was no longer just about stocking shelves. It was about technology, logistics, private labels, and pricing wars. Kroger had survived for over a century by adapting. But in this new era, survival required more than adaptation. It required reinvention.
If you want to understand Kroger's future, you have to understand one uncomfortable truth. Grocery retail is one of the hardest businesses in America. Margins are razor thin. Most traditional supermarkets operate on profit margins of 1 to 3%. That means for every $100 you spend, the company might keep just $1 or $2 after expenses. Now imagine competing in that environment against Walmart, a company with enormous purchasing power and scale, or Costco, which thrives on membership loyalty and bulk economics, or Amazon, which can afford to sacrifice profits for market share. This is the battlefield Kroger operates in every single day: the private label weapon. So how does Kroger protect its margins? Private labels. Instead of only selling national brands like Coca-Cola or Kellogg's, Kroger has built a powerful portfolio of store brands. The most successful of these is Simple Truth, an organic and natural foods line that has grown into a multi-billion-dollar brand. Private labels are crucial because they generate higher margins. Kroger controls sourcing, pricing, and branding. It reduces reliance on big consumer packaged goods companies and increases negotiating leverage. Over time, Kroger expanded its portfolio beyond budget alternatives. It created premium offerings like Private Selection and value lines targeting cost-conscious shoppers.
And during inflation, this strategy became even more important. As food prices rose in 2022 and 2023, consumers traded down from expensive national brands to cheaper store brands. That shift benefited Kroger. But private labels alone can't solve everything. The inflation squeeze. Inflation hit the grocery sector hard. Higher fuel costs meant more expensive transportation. Labor shortages pushed wages higher. Commodity prices fluctuated unpredictably. Consumers felt the pressure too. When grocery bills rise, shoppers change behavior. They buy fewer discretionary items. They switch to discount chains. They compare prices more aggressively. Kroger found itself walking a tightrope. Raise prices too much and customers leave. Absorb costs and margins collapse. Unlike tech companies, grocery retailers can't simply scale software. They must manage physical inventory, cold storage, perishable goods, and shrinkage, the loss of products due to spoilage or theft. Every operational inefficiency eats into profits. And then there's labor. The labor challenge. Grocery stores are labor-intensive businesses. Cashiers, stockers, butchers, warehouse workers, delivery drivers. Wage pressure has increased significantly over the past decade. Union negotiations add another layer of complexity. Strikes at regional locations have occasionally disrupted operations. Automation helps. Kroger has invested in robotic fulfillment centers and digital inventory systems, but you can't fully automate fresh produce or customer service. Technology improves efficiency. It doesn't eliminate costs. The scale question. This brings us back to the proposed merger with Albertsons. The logic behind the acquisition was simple. Bigger scale equals stronger negotiating power with suppliers. Stronger negotiating power equals better pricing. Better pricing equals survival. But critics argue that scale has limits. Even as one of America's largest grocers, Kroger still operates in a fragmented industry with intense regional competition. Discount chains like Aldi continue expanding. Dollar stores are increasing grocery offerings. Walmart remains dominant. So the real question becomes, is grocery retail a scale game or a margin trap? Because even with billions in revenue, if profits remain thin and growth slows, the stock market eventually notices. Investors don't reward size alone, they reward sustainable profitability. And while Kroger has remained profitable, unlike many struggling retailers, its growth has been steady, not explosive. That might sound stable, but on Wall Street, stability isn't always exciting.
After 140 years in business, Kroger faces a simple but brutal question. Can a traditional grocery giant thrive in a world that no longer looks traditional? The grocery industry is evolving faster than ever. Consumers expect convenience, they expect digital integration, they expect low prices, always, and they expect transparency around sourcing, sustainability, and health. Kroger sits at the center of all of it. The merger outcome and regulatory pressure. The proposed acquisition of Albertsons was meant to reshape the competitive landscape. Whether fully approved, partially restructured, or blocked by regulators, the process itself revealed something important. Scale is no longer optional. To compete against Walmart, which generates hundreds of billions in annual revenue, or Amazon, which blends logistics with artificial intelligence, regional strength isn't enough. You need national leverage. If the merger succeeds, Kroger becomes significantly larger, potentially gaining pricing power and operational efficiencies. But integration carries risk. Cultural clashes, system consolidation issues, store divestitures, and political scrutiny. If the merger fails, Kroger still must compete, but without the additional scale it believes is necessary. Either outcome carries consequences. The digital battlefield. The future of grocery is hybrid. Physical stores remain essential, especially for fresh food, but digital ordering is now permanent consumer behavior. Kroger's investment in automated fulfillment centers and pickup infrastructure gives it a competitive advantage over smaller regional grocers. However, profitability in online grocery remains challenging. Delivery costs money. Picking individual orders costs money. Packaging costs money. Unless efficiencies improve dramatically, digital grocery can dilute margins rather than enhance them.
Kroger's bet is that over time, scale and automation will reduce those costs. But time is a luxury in competitive retail. Data, the hidden asset. One of Kroger's most underappreciated strengths isn't food, it's data. Through loyalty programs and digital platforms, Kroger collects enormous amounts of customer purchasing information. That data fuels targeted advertising, personalized discounts, and retail media revenue, an increasingly important profit stream. Retail media allows brands to pay Kroger to promote products directly to shoppers through digital ads and in-store placements. Margins in advertising are far higher than margins in selling milk or bread. If Kroger can continue expanding this segment, it may offset the structural limitations of grocery economics. In many ways, Kroger is becoming part grocer, part data company. The competitive horizon. But competition isn't slowing. Discount chains like Aldi continue expanding aggressively in the U.S. Warehouse clubs maintain strong loyalty. Walmart continues pushing grocery prices lower. Meanwhile, consumer behavior is shifting again. Younger shoppers prioritize convenience and speed. Meal kits, prepared foods, and quick commerce delivery services compete for share of stomach. And then there's macroeconomic uncertainty. Recessions change spending habits. Inflation changes brand loyalty. Supply chain disruptions remain unpredictable. Through it all, Kroger must remain agile. The big question. Kroger is not a flashy growth stock. It doesn't dominate headlines like tech giants. It operates in a mature, brutally competitive industry with slim margins and constant pressure. But it has survived for a century by adapting, from bakeries in the early 1900s to supermarkets in the mid-20th century to digital logistics networks in the 21st. The company's future won't be defined by hype. It will be defined by execution. If Kroger can maintain price competitiveness, expand private label dominance, improve digital efficiency, grow high-margin retail media revenue, and navigate regulatory challenges, then it doesn't just survive, it strengthens. But if margins compress further, digital costs spiral, and scale advantages fail to materialize, even a 140-year-old institution can struggle. The grocery industry rarely produces dramatic collapses. It produces slow pressure. And in business, slow pressure can be just as dangerous as sudden disruption. Kroger's story is not about meteoric rise or spectacular crash. It's about endurance. The question is whether endurance alone is enough in a world where retail never stops evolving. Because in grocery, as in business, staying alive is impressive. But staying dominant? That's something else entirely.